Stock options are advanced tools in addition to stock investing. They are highly speculative. If used wisely, they can significantly boost your returns. But if used incorrectly, they can quickly destroy your investments. There are two basic types of options, calls and puts. And while there are many different strategies, the four most common are buying calls, buying puts, selling covered calls, and selling cash secured puts. In today's video, I will break down what a call option is and show you how two key call option strategies work. By the end of this video, you will also understand how popular covered call ETFs such as SPYI and QQQI generate high dividend yields for investors. This channel is all about investing and personal finance to help you retire early. An option is simply a contract between two parties. A call option contract is an agreement between the buyer and the seller that gives the buyer the right but not the obligation to buy 100 shares of a stock at an agreed price within an agreed time frame. The agreed price is called the strike price, and the time frame is the expiration date of the option contract. Why would someone want to buy call options? To understand this, imagine you run a steakhouse restaurant and your main ingredient is beef. As a restaurant owner, you expect higher inflation ahead and want to protect your business from potentially rising beef costs. You decide to negotiate a purchasing contract with your wholesaler to lock in the beef price 6 months from now. Say beef is selling for $8 per pound today. Under the contract, you can still buy it at $8 per pound for at least 100 pounds, but you must pay an upfront premium of $1 per pound, or $100 total. The contract expires in 6 months. Of course, there's no guarantee beef prices will rise before then, but the contract protects you from the risk of a sharp price increase that could hurt your business. That $100 premium is essentially the cost of insurance, because in many ways, a call option works just like an insurance policy. Now, if beef jumps to $12 per pound before the contract expires, wouldn't you be happy to exercise the call option? Absolutely. After adding the $1 premium, your effective cost is $9 per pound, saving you $3 compared to the market price. From this example, for the contract to be worthwhile, the future beef price needs to rise above your total cost of $9 per pound. That's your break-even point. If the price is still at $8 at expiration, the contract offers zero value because you could simply buy beef on the open market at the same price. In that case, the $100 premium you paid is a total loss. In real life, many businesses use this strategy to hedge against rising material costs. For instance, automakers often purchase call options on copper. However, as a retail investor, the most common reason for buying call options is to profit from the option's price appreciation, unless using it as a hedge against a short position. Since I don't recommend shorting stocks due to the unlimited risks and margin costs, we'll only focus on call options for straightforward appreciation purposes. Now let's look at a real example to see how this strategy works. I own shares of the brokerage company Robinhood because I believe it will benefit from friendly crypto regulations and its strong earnings growth. Today, it's trading at around $126 a share, and I expect the stock to rise in the near future. Instead of buying another 100 shares, which could cost me $12,600, I want to spend no more than $4,000 on a call option, while still being able to control the same 100 shares and participate in the stock's upside. In this case, I would buy one call option contract. Remember, one option contract always controls 100 shares of the underlying stock. Let's assume my analysis suggests Robinhood could be worth about $160 in 6 months. That's the premise behind this trade. Pulling up Robinhood in my brokerage account and open the option chain, I see a table showing different strike prices along with their bid and ask quotes. Next, I filter for call options expiring 6 months from now. on March 20th next year. So here's the big question. Which strike price should I choose? It depends on the option cost and the risk reward of the trade. For example, if I pick the $160 strike, the option costs $12 per share. So what price does the stock need to reach to break even at expiration? The answer is $172. Simply the strike price plus the premium. Only if the stock goes above $172 would I actually make a profit. But based on my analysis, Robinhood may be worth around $160 by expiration. It could go higher, but that's unlikely. That makes the $160 strike too risky, since there's a good chance I'd lose my entire premium if the stock finishes below $160, a scenario known as being out of the money. Instead, let's look at the $100 strike price. The premium here is $37 per share. If the stock reaches $160 at expiration, the option would be worth $60, the difference between the market price and the strike price. That's called being in the money. Subtracting the $37 premium leaves a profit of $23 per share, or $2,300 total. That's a 62% return on my $3,700 investment. In this case, the stock needs to rise 27% in 6 months from 126 to 160 for my option trade to deliver that 62% gain. This is a clear example of leverage. Using just $3,700 for a call option can more than double the return compared to putting $12,600 into the stock. But on the flip side, if the stock falls below 100, I would lose my entire investment in this trade. It's important to know that, unlike stock investing where you have time on your side and can wait for the stock to recover, buying options is much riskier because time works against you. To succeed in trading options, you not only need to be right about the price direction, but also about timing. In future videos, I will share some of the secrets professional option traders use to give themselves an edge and generate incredible returns. Now let's talk about a less risky strategy with call options, writing covered calls. This shouldn't be a new concept if you remember the steakhouse example. When the beef wholesaler sold you a contract to buy beef at $8 per pound for a $1 premium, he was essentially writing a covered call. Let's apply that idea to Robinhood stock again. My expectation is still the same that the stock could reach 160 per share in 6 months, but going all the way to 170 seems unlikely. So I can sell a covered call contract with a 170 strike for $10 per share. To do this, I must already own 100 shares of Robinhood stock. Just like the wholesaler needed beef in inventory before selling contracts, I need to own the shares in case the buyer decides to exercise. There are 3 possible outcomes. First, if the stock never reaches 170, the option expires worthless. The buyer won't exercise, and I keep both my 100 shares and the $1,000 premium collected. This is the ideal scenario, and I could continue writing cover calls again and again for extra income. Second, if the stock jumps to 185, the option holder will exercise the contract and buy my shares at 170. In that case, I earn the $10 premium plus the difference between the 170 strike and the initial purchase price of my shares, assumed at $100. The total profit will be $80 per share, 70 from the price difference plus $10 premium, or total $8,000. Not bad at all, but there's a trade-off. If I had to simply held these shares, I could have sold them at 185 for an extra $5 profit per share. And if I want to keep writing cover calls afterwards, I'd have to buy back the shares at a higher market price. That's the key downside of this strategy. Third, if the stock trades somewhere between 170 strike and the buyer's break-even point 180, the option holder may or may not exercise. They might choose to exercise at a loss and buy and hold the shares for future gains, or simply let the contract expire if it's only slightly in the money to avoid putting up more capital since there's no obligation to buy stocks. It's important to know that as the seller of a covered call, I also have control over how I want to exit the trade. I don't have to wait for the buyer to act. At any time before expiration, I can buy back the same option to close my position, whether at a profit or a loss. Personally, while covered calls can provide steady income, I prefer the cleaner, simpler approach of buying calls and trading them for higher profit potential without tying up my existing holdings. That said, covered calls are still an excellent income strategy if managed well, and it's the exact approach many popular high dividend ETFs like SPYI and QQQI use. I will share more thoughts on those ETFs in a future video. See you soon.